Okay, imagine this. A 155-year-old company, a real spirits dynasty, 81 straight years of paying dividends. Sounds solid, right?
Okay.
But now, their stock price has basically been cut in half. So the big question we're tackling today is Brown-Forman, ticker BF.B, a classic value trap, or maybe, just maybe, a once-in-a-generation buying opportunity? We're diving deep into the sources to really understand what's going on behind these recent struggles. Today's analysis date is June 27th, 2025, and the stock closed at $26.46.
Yeah, and with a company like Brown-Forman, there's just so much information out there, decades of history, global operations. It can be overwhelming. Our aim here is really to pull out the core insights, the stuff that actually matters, to help you cut through all that noise.
All right, so let's get into it. We'll walk through this chapter by chapter, starting with the business itself. Chapter 1, Business Understanding. Okay, so what does Brown-Forman actually do? At its heart, it's about making, marketing, and selling premium and super premium alcoholic drinks globally. We're talking over 40 different brands sold in, more than 170 countries. And they've got about 5,700 employees making it all happen. It's a pretty significant operation.
Definitely. And their main moneymaker is selling those finished bottles, the case goods. Now, how they get those bottles to you is interesting. It's a bit of a hybrid approach. In the U.S., they operate within that, complex three-tier system selling to distributors or state governments. But internationally, they've made this really big strategic shift. They've poured a lot of capital into owning their own distribution companies in 16 key countries. Japan and Slovakia are the latest ones.
And that's a big move, right? Investing heavily in distribution when maybe cash is tight. Why do that?
Well, it's a long-term play. Short-term, yeah, it costs a lot and might seem less efficient, but long-term, it gives them way more control. Control over the brand message, pricing, how the bottles look on the shelf. They're essentially cutting out the middleman to grab more of the profit margin and build direct relationships. It's about trading that short-term efficiency hit for, hopefully, stronger brand equity and better margins down the road. They even make a little bit selling used barrels. Fun fact.
That makes sense, wanting that control, especially for premium brands. And speaking of brands, let's talk products. Jack Daniel's family of brands, that's the giant, right? Their most valuable asset.
Absolutely. That's the engine. But they're not just Jack Daniel's. You've got Woodford Reserve, which is a leader in super premium American whiskey globally, and Old Forester, that's the original brand from 1870. Plus, they've been diversifying. Super premium tequila like Herradura and El Jimador. And more recently, they bought Diplomatico rum and Gin Mare. Oh, and they're big in the ready-to-drink space, too. New Mix in Mexico is huge. And that global Jack Daniel's and Coca-Cola RTD partnership is massive.
So, quite a portfolio beyond just whiskey. How do they stack up in the global market then?
Well, position-wise, they're considered the fifth largest global spirits company, active in over 170 countries. Now, their market share figures like 4.65% in consumer non-cyclical or maybe 9.15% among beverage peers might seem kind of low. But honestly, that's not really a weakness here. It just shows how incredibly fragmented the spirits industry is. It actually signals there's a lot of room for them to grow, especially by targeting those premium niches, which is exactly their strategy. They don't need to own the whole market.
Right, they focus. And their core value proposition, going all the way back to 1870, is nothing better in the market. Quality, authenticity, premium plus spirits. That ethos really drives them.
Okay, so that's their approach. How does it mesh with the wider industry trends? The global spirits market seems to be growing. It is, yeah. Projections are pretty solid, maybe 3.7% to almost 10% CAGR, potentially reaching, $800 and $950 billion by 2030. Huge market, but it's shaped by some really powerful consumer trends. First, premiumization. People drinking less but better. That's a tailwind for Brown-Forman. Second, category diversification. Tequila and agave spirits are booming. RTDs are exploding. That's both an opportunity and a challenge for a whiskey-focused company. Third is health and wellness, the whole moderation movement, people looking for low or no alcohol options. That's definitely a headwind structurally. And finally, sustainability and authenticity. Consumers want eco-friendly stuff, local stories. So you see, it's complex. Premiumization helps them, but tequila competition and moderation trends are definite challenges right now. You can almost map their recent struggles directly onto these cross-currents.
Makes sense. And the competition isn't exactly sleeping. It's an oligopoly, really. Dominated by giants like Diageo, they've got almost 38% market share. Then Pernod Ricard, Constellation Brands. It's intense. Constant battles over marketing, price, new products. Just for scale, Brown-Forman's market cap is around $12.5 billion. Diageo, $58 billion. Revenue-wise, BF.B is about $4 billion LTM. Diageo is nearly $28 billion. Interestingly, though, Brown-Forman's PE ratio, priced earnings, is actually a bit lower right now, around 15.9x versus Diageo's 16.9x.
And adding another layer of complexity is the regulatory environment, especially in the U.S. It's one of the most heavily regulated sectors thanks to the 21st Amendment. You've got 50-plus state frameworks, federal oversight. But the critical piece is the legally mandated three-tier system. Producers, wholesalers, retailers, they have to be separate. This makes the distributor, the wholesaler, a really powerful gatekeeper. Tight house laws reinforce this separation.
Can you break that down a bit? How does that three-tier system actually impact them day to day?
Okay, imagine Brown-Forman creates a fantastic new whiskey. They can't just send it to your local liquor store or bar. Nope. They must sell it first to a licensed distributor in that state. And those tight house laws, they mean Brown-Forman can't, say, offer special payments or own a piece of that bar just to get them to push their product. It forces independence. For a big player like Brown-Forman with established relationships, it's a benefit, a barrier to new entrants. But if you're a small craft distiller, getting a distributor to even take your product is incredibly hard and costly.
So these regulations create massive barriers to entry, a formidable protective moat, as some call it. They've got the regulatory maze, the fight for distribution access, the huge capital needed for distilleries and aging inventory, plus massive brand building costs.
Exactly. Though it's worth watching the emerging fourth tier. These direct-to-consumer platforms like Drizzly, GoPuff, they could potentially disrupt things long-term, maybe lower those barriers a bit and heat up competition. Something to keep an eye on.
For now, though, that moat seems pretty wide. Morningstar recognizes it. You mentioned brand strength Jack Daniel's as a global icon. That gives them pricing power, loyalty. How does that heritage aspect, with Woodford and Old Forester too, play into this premiumization trend?
It's absolutely central. In a world leaning towards less but better, brands with genuine heritage, authenticity, a real story, they resonate. Woodford Reserve, Old Forester, even Jack Daniel's, they embody that. It's not just about the liquid, it's about the history, the craftsmanship. Consumers are willing to pay more for that perceived quality and authenticity, which fits perfectly with the premiumization push. It gives them a narrative that newer brands struggle to match.
Okay, so brand strength is key. What else contributes to the moat?
Well, cost advantages from economies of scale buying grain and bulk, running efficient distilleries, global logistics, also network effects, though maybe not in the tech sense, more like the deep established relationships they have within that three-tier distribution system, hard for others to replicate quickly. And then unique assets. The actual distilleries, those massive aging warehouses full of whiskey proprietary recipes. And maybe most importantly, that family-controlled ownership structure. It ensures a focus on long-term brand health, not just quarterly results.
Chapter 2, Management Evaluation. All right, let's talk leadership. CEO Lawson Whiting is at the helm, but the Brown family has steered this ship for generations through prohibition, wars, recessions. They've seen it all. But this current situation feels different. Maybe one of the most significant tests they faced recently. It's like a perfect storm hit them. You've got the inventory glut after the pandemic boom, a really sharp downturn in financials. Q4 fiscal 25 net sales dropped 7%, which is big. And then the bombshell in June 2025, that securities fraud investigation announcement.
Yeah, that investigation changes the game. Management's reacting, sure. They've announced restructuring, layoffs, plant closures, aiming for maybe $70–80 million in annual savings. And they're continuing the portfolio shift towards premium stuff. But this legal probe, it hits right at the core: forecasting, transparency, trust. It makes this crisis fundamentally different and, frankly, more serious. The big question now is this just a temporary blip they can fix? Or does it point to something deeper, a systemic issue? That investigation is a huge, unquantifiable risk hanging over them.
And it's such a contrast, isn't it? Brown-Forman has always highlighted its ethics, even got awards like World's Most Ethical Companies. Does an investigation like this just shatter that image?
It definitely puts a huge dent in it. Reputation is hard-earned and easily lost. Even the allegation of misleading investors calls their integrity into question, regardless of the final outcome. It's a major challenge to that long-standing ethical reputation.
Okay, let's look at how they're using their capital. Seems like a two-track strategy. First, investing heavily in the core business. They spent over $400 million in CapEx in fiscal 23 and 24, planning another $200 million or so for fiscal 25. Mostly expanding production for whiskey, tequila, rum.
Right. And second, their M&A, mergers and acquisitions, seems pretty disciplined. They've sold off slower stuff like Southern Comfort, Tuaca, Finlandia, and then they've used that cash to buy into faster-growing, higher-margin categories. Think Benriach Scotch, Diplomatico Rum, Gin Mare that was over $1 billion just in fiscal 23. It's a clear reaction to those industry trends we discussed, shifting the portfolio.
And what about returning cash to shareholders? That seems core to their identity.
Oh, absolutely non-negotiable. They're an S&P 500 dividend aristocrat. That means 41 consecutive years of dividend increases. They've paid dividends regularly for 81 years. The current yield is attractive, over 3%, and it's backed by a payout ratio of only 48%, which is very comfortable. That dividend is safe. They also do share buybacks sometimes. They did spend $400 million back in December 2023, when the stock price was quite a bit higher than it is now. That timing does raise some eyebrows about capital deployment effectiveness, looking back.
Let's talk about return on invested capital, ROIC.
Yeah.
Morningstar calls it exemplary, right? Normalized around 15.8%, historically even hitting close to 30%.
Historically, yes, very strong. But that's where we see the recent pressure reflected clearly. The ROIC has trended down, hitting 13.7% for the 12 months ending April 2025. Now, that's still well above their cost of capital, their WACC, which is estimated around 6.45%, so they're still creating value. But the trend is the worrying part.
Why is it declining?
It's a combination. Their core profit after tax, no PAT, is getting squeezed. Higher costs for grain, glass, energy, plus lower production volumes mean a fixed costs hit harder, and operating expenses are up. At the same time, the invested capital part of the equation is increasing because of all that CapEx spending on distilleries and the money spent on those recent acquisitions. So basically, they're investing more capital but generating less profit per dollar invested than they used to. That ROIC decline really tells the story of the current challenges. The key question is whether these new investments can eventually turn that trend around.
Chapter 3. Financial analysis. Okay, let's put some numbers on this. As of late June 2025, their market cap is hovering around, what, $12.5 to $13.5 billion?
Somewhere in that range, yeah. And revenue growth. Well, it was solid for a few years, peaking in fiscal 23 at over $4.2 billion. But then, bam, a sharp reversal. The trailing 12 months figure ending April 25 is $3.98 billion. That's down almost 5% year over year. And that negative growth is really spooking the market.
Profit margins are feeling the heat, too. Gross margin, usually a strong point near 60%, slipped just under 59%. Input costs, lower volumes hitting that. Operating margin is down too, around 27.9% TTM, below their historical 30% plus levels, partly due to advertising and admin costs. Net profit margin is sitting around 21.9% TTM.
And free cash flow, which you'd expect to be strong for a company like this, has actually been pretty volatile. No clear growth over the last 5 years. That $680 million TTM is lower than previous years. That inconsistency in cash generation is definitely a concern for investors.
What about financial stability? Their earnings track record looks a bit broken now. Diluted EPS, earnings per share, dropped from $2.14 in fiscal 24 down to $1.84 TTM. And forecasts for fiscal 26 actually suggest it might fall further. That's a big change from their usual reliable pattern.
It is. But importantly, the balance sheet looks much healthier. Their debt-to-equity ratio is quite moderate. They've actively managed it down to about 0.61x. That's a real source of strength. Total debt around $2.7 billion against equity of $4 billion. And their current ratio, exceptionally strong at 3.88. That gives them a ton of financial flexibility to weather this storm.
So it's a split picture, really.
Exactly. You've got this clear divergence. The income statement looks stressed, volatile, weakening, but the balance sheet, strong, stable, providing a cushion. It gives management time and resources to try and fix the operational issues. And like we said, that dividend feels very secure because of that balance sheet strength and a manageable payout ratio.
Okay, so financials are a mixed bag. How is the market valuing all this? Let's get into valuation. Relatively speaking, how does it look? Well, the PE ratio is currently around 15-16 times earnings, which on the surface looks pretty inexpensive, doesn't it? Especially compared to its history.
Dramatically inexpensive compared to history. Its 10-year average PE is over 30. And just back in July 2023, it was trading above 44 times earnings, so a massive contraction. It's also trading below its peers, who average around 19.4x, and the broader industry average of about 24x. So yes, relative valuation says it looks cheap.
But cheap can sometimes mean value trap. What about intrinsic value, like using a discounted cash flow model?
Right. The DCF approach tries to calculate what the company is actually worth based on its future expected cash flows, discounted back to today. It works best for stable, predictable companies, which Brown-Forman usually is, but isn't right now. So there's definitely a higher degree of uncertainty in the inputs for the model today.
Okay, with that caveat, what does an educational DCF model suggest?
Our model spits out an estimated intrinsic value range of $28 to $34 per share, which is interesting because Morningstar has a 5-star price, their buy price at $29.40, but their overall fair value estimate is much higher at $43.33. So some divergence there too.
And what assumptions are baked into that $28-$34 range?
Key ones are a discount rate, or WACC, of 7.5%. That's conservative, reflecting the higher risks right now. For near-term growth, we use -2% for the next fiscal year, matching guidance, then slowly recovering to 0%, then 3% over the following years, and a long-term perpetual growth rate of 2.5%, basically in line with inflation and the economy. Look, the DCF is sensitive to these assumptions, but what it tells us is that the current stock price, down at $26.46, seems to be baking in a really pessimistic scenario, basically, prolonged negative or even zero growth for quite some time. So the whole investment thesis really boils down to this. Do you believe this current slump is temporary, cyclical, something they can fix, or is it a sign of permanent damage, a structural decline? Your answer to that determines if today's price is an opportunity or a trap.
Chapter 4. Market Sentiment. So how is the market feeling about BF.B right now? Wall Street analysts seem pretty cautious. The consensus is basically hold or neutral. The average 12-month price target sits between $32.29 and $32.08. That suggests, maybe 18-21% upside from here. But the range of targets is huge, from $25 all the way up to $47. And we've seen mostly negative revisions lately, downgrades, target cuts.
Yeah, and the headlines in the financial media, overwhelmingly negative, all about the dismal Q4 earnings, calling it one of the worst performing stocks, and constantly mentioning that securities fraud investigation. Even Jim Cramer weighed in, saying they reported a truly terrible quarter. That kind of commentary really reflects the deep pessimism out there.
Market indicators seem to back that up too. Short interest, for example.
It's really high. About 30.5 million shares are being shorted. That represents 10.54% of the publicly available shares, the float. That's a significant number, signaling widespread pessimism. And the days to cover ratio is also high, at 8.4 days. That means, based on average trading volume, it would take over 8 days for all the short sellers to buy back their shares. It points to a very crowded bearish trade.
So lots of people betting against the stock.
Exactly. But that high short interest is a bit of a double-edged sword. On one hand, it confirms the market sees real risks. On the other hand, it sets up the potential for a short squeeze. If some unexpected good news comes out, maybe a better-than-feared earnings report or positive developments on the investigation, all those short sellers might rush to buy back shares to limit their losses. That sudden buying pressure can cause the stock price to jump rapidly. It makes the stock kind of like a coiled spring right now, very sensitive to any news that counters the negative story.
And technically, looking at the chart,
it's just a clear and strong downtrend. The price is way below both its 50-day moving average, around $31.80, and its 200-day moving average, near $37.52. That reinforces the negative sentiment and the technical weakness.
Chapter 5. Ownership structure. Let's talk about who owns Brown-Forman. It seems like a lot of big institutional players hold it, right? A core holding for many large managers.
Yeah, institutional ownership is high. Estimates range from around 49% up to 77%. You see names like the Vanguard Group, BlackRock, State Street, the usual suspects. They own significant chunks, between, say, 3% and 8.5% each, that suggests a certain level of foundational confidence. These huge managers often hold quality companies for the long term.
So what does it tell us that these big fish are still holding on, maybe even buying a bit, during all this turmoil? Is that a vote of confidence?
It's definitely a positive sign, I think. These are generally long-term, often index-tracking investors. Their continued presence suggests they see the underlying quality, the dividend aristocrat status, and maybe believe the current issues are temporary. When giants like Vanguard and BlackRock stick around, it usually means they're looking beyond the immediate negative headlines. The fact that some might even be net buyers could indicate they view this dip as an opportunity. It counterbalances some of the negativity.
Okay, what about insiders, the people running the show?
Well, direct insider holdings are relatively low, about 3.2%, and that's mostly the Brown family members, like Campbell P. Brown, who holds about 1.4%. But here's the crucial point. There's been a notable lack of open market buying by these insiders, even with the stock at multi-year lows. People sell stock for all sorts of reasons, taxes, diversification, but insiders usually only buy if they think the stock is undervalued and has a bright future. So the absence of significant insider buying right now, it's seen by many as a cautionary yellow flag. It doesn't scream confidence from the inside.
And ownership concentration. The top 25 holders control almost 60%. But the real concentration isn't just ownership, it's control, right? And that lies firmly with the Brown family.
Absolutely critical point. Through their direct holdings and entities like Wolfpen Branch LP, which owns over 20%, the Brown family controls the majority of the supervoting Class A shares. This dual-class structure means they have absolute control over the company's direction, strategy, board appointments, everything. Public shareholders of the Class B shares, BF.B, have basically no voting power.
What are the implications of that structure for an outside investor?
It's profound. Investing in BF.B is fundamentally a bet on the jockey, a bet on the Brown family. You're placing explicit faith in their character, their competence, and their commitment to acting as good long-term stewards of your capital, even though you have no say. On the plus side, it shields the company from short-term activist investors demanding quick fixes that might hurt the long-term brand. But the downside, if you as a public shareholder become dissatisfied with management or strategy, there's really no mechanism to force change. This elevates the qualitative assessment, judging management's integrity and ability to paramount importance. It's not just about the numbers, it's about trusting the family in charge.
Chapter 6. Risk assessment. Let's quickly run through a SWOT analysis. Strengths, weaknesses, opportunities, threats. Strengths seem clear. Iconic brands like Jack Daniel's, that deep heritage, dividend aristocrat status, solid balance sheet, high barriers to entry.
Yep. For weaknesses, the big ones are that heavy reliance on Jack Daniel's, the recent sharp financial deterioration we've discussed, that ongoing securities fraud investigation, which is a major legal and reputational cloud, and the lack of insider buying we just talked about.
Opportunities include tapping further into that global premiumization trend, growing the RTD and Tigre Agave parts of the portfolio where they've invested, expanding in emerging markets, potential for margins to recover eventually, and maybe leveraging those new e-commerce DTC platforms, that fourth tier.
And threats. Intense competition from Diageo, Pernod Ricard, and others. That structural shift towards moderation and no alcohol options hitting their core whiskey base. A potential economic slowdown curbing discretionary spending on premium spirits. Plus macroeconomic factors. Inflation is still pushing up costs for grain, glass, energy. Higher interest rates increase their cost of capital and could dampen consumer spending further. And geopolitical risks are always there. Imagine new trade tariffs, like a hypothetical U.S. tariff on Mexican goods hitting their tequila, or retaliation against Jack Daniel's. That forces them to think constantly about pricing, hedging, and diversifying supply chains.
Chapter 7. Conclusion. Okay, let's pull all this together. What's the bull case for Brown-Forman right now? Well, it centers on that durable competitive moat. The brands, the barriers. The stock looks incredibly cheap compared to its own history and its peers, trading at that mid-teens PE versus 30+ historically. You get a rock-solid growing dividend from a dividend aristocrat with a strong balance sheet. Management is actively trying to reshape the portfolio for growth. And maybe, just maybe, the extreme negative sentiment and high short interest create a contrarian, coiled spring opportunity for a rebound.
Okay, but the bear case is pretty powerful too. The financial fundamentals are actively getting worse right now. Declining sales, squeezed margins, weak outlook. They seem caught on the wrong side of some major industry trends, with tequila and moderation pressuring their core whiskey business. And most critical, you have that significant, completely unquantifiable risk from the securities fraud investigation. That raises the real specter of a value trap, where the stock is cheap for a reason, and the lack of insider buying doesn't help dispel that fear.
So, valuation summary again. Our educational DCF model pointed to an intrinsic value range of $28 to $34 per share. Analyst consensus is right in that ballpark too, around $32, $33.
Right. So the concluding outlook as of June 27th, 2025, with the share price at $26.46, is that it is trading below the low end of that estimated intrinsic value range. For a patient, long-term investor who believes strongly in the brands, has a high tolerance for risk right now, and thinks these headwinds are temporary, today's price could look like a compelling entry point into a high-quality business that's facing severe, but perhaps temporary problems. But for more cautious investors, the operational uncertainties are significant, the momentum is clearly negative, and those unresolved legal and governance questions surrounding the investigation and family control, they arguably fully justify the market's deep pessimism right now. Ultimately, it really comes down to this. How much conviction do you have in the current management under the Brown family's control to navigate this crisis successfully and execute that strategic pivot back to profitable growth? That's the deciding factor.
So here's a final thought to chew on. When the Brown family hold all the voting power, and you as a public shareholder have zero say, How much does your personal conviction in their integrity and long-term vision really count when the company hits a perfect storm like this? Something to consider. We really hope this deep dive gave you a valuable shortcut to getting informed on Brown-Forman. If you found this useful, please do hit that like button and subscribe to the Stock Analytics AI YouTube channel. For just $4.99 a month, members get priority deep dives on tickers. We're actually planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access for suggesting stocks in the comments too. Or if you just want a one-off deep dive on a specific company, drop us a super thanks.
And please always remember, this analysis was generated by an AI system. It's purely for educational purposes and should absolutely not be taken as financial advice. Always do your own thorough research or consult with a qualified financial advisor before making any investment decisions. Stay curious and stay informed.